Another thing that we'll be watching here in Canada tomorrow, we will have bank earnings to contend with. Both Royal and TD will be reporting results. Here you can see that the Canadian banks have underperformed the broader market, but our next guest says we could be poised for some upside surprises when they start to report. Let's bring in John Aiken, who is with Barclays and covers the banks and insurers. Thanks so much for being with us.
Good morning, Amber.
So talk about where we could be surprised to the upside.
Well, absolutely. So we've seen a lot of bad news being priced in for the banks, particularly after we saw the U.S. bank earnings season really not be that fantastic. Now, I've got to say on the outset, we're not looking for great earnings out of the banks, but basically a reset in expectations have lowered the bar, and we do think that there's a possibility that the Canadian banks could surprise a little bit to the upside. Now, again, outlook's still not fantastic for the rest of the year, so it's a bit of a trade bump, but basically we're looking for a little bit better revenues. We actually did see 2 rate hikes from the Bank of Canada during the earnings season. So that could give them a little bit of relief on margins. We're still continuing to see lending volumes increase, granted not at the same pace as we have in the past. And as well...
And is that on the mortgage side, the commercial side?
It's actually on both. So
okay.
We actually saw a very strong spring season for residential mortgages, but we're still seeing commercial lending volumes continue to remain robust and better than we're seeing on the personal side. And then on the flip side, expenses, that's always a bit of a wild card. We don't really know what the banks are doing until we actually get the results, but we've actually seen some fairly weak performance when it comes to expenses, and given the fact that the banks are expecting revenues to slow down, we wouldn't be surprised to actually see them pull back on expenses and give a bit of a breathing room on operating leverage.
Let's use Royal Bank as a poster child of this. Almost every call recently with Dave McKay, you've heard him complain about expenses. He's aware of the problem, and yet Royal typically always trades at a premium to the group. And so I think in this environment, you have people questioning, well, is that warranted? Should they still trade at a premium to the group? How are you thinking about the setup for Royal in particular?
Absolutely. We're given the commentary that we had out of Royal over the last several quarters, a little bit surprised that we didn't actually see a restructuring charge come out of the bank on this quarter. Now, it still could happen tomorrow when they announce earnings.
A restructuring
charge.
Okay.
But given the fact that we haven't had a pre-announcement on that, it's probably not going to happen. But I do think that the market is going to be really looking at the sequential and year-over-year expense growth for Royal to see how active they've been in terms of trying to cut those expenses.
Are you a buyer?
No, we're negative on Royal, largely because of the valuation. Now, Royal, it is best in class. It does deserve a premium. However, the absolute multiple that it's trading at, as well as relative to the group, we think is a little bit stretched, and are expecting it to come back down within a little bit more reason.
This is where it's so interesting in the space right now, because there are all those headwinds that you named, and it's very much out there, but the extent to which it's already priced in. So if you don't think that Royal is adequately reflecting that, is there a stock that's, kind of down and dirty that you think is maybe getting overly punished? Yeah,
well, actually, we're a little bit surprised at the underperformance of Bank of Montreal relative to the group. Now, granted, the results are going to be a bit muddied because we've got Bank of the West now for the second quarter in a row in there, but actually I think that gives BMO a lot of opportunity in terms of surprise to the upside, in terms of revenues, in terms of expense cutting, and also on the initial reports on Bank of the West, they did front load a lot of provision for credit losses. So we actually do think that their provisioning this quarter is not going to be nearly as bad because that portfolio has already been taken care of.
Out of the major banks, BMO is the only one that you have an rating on. Why is that?
Well, the outlook for the economy is really not that strong. And, well, it's actually gotten a lot better over the last 3 months. There's still, even if we're not going to be into a big recession, there's a possibility of recession or at least an economic slowdown. And as everyone is anticipating with the banks, that's going to lead to higher credit losses. Now, we still haven't seen that develop. And if you'd asked all of us on the street at the beginning of the year, it should have materialized by now. But we do think that's going to put pressure in 2024 earnings. And honestly, well, we've seen the Canadian bank stocks drop down. We're a little bit more comfortable with the valuations as they sit now. Obviously, we did increase our target prices heading into the quarter, but we still think that there's a bit of a downside shock in the fourth quarter and first quarter. So we're still not advocating piling in at this stage.
CIBC has been the worst performer of the group, in part because of that domestic exposure. It is trading at the lowest level. It's bouncing off of not just a 52-week low, but almost a 2-year low. But you're still not tempted.
We're getting there, but still not, again.
What do they need to show?
Well, a lot of it will be dictated by what they report next week. But again, they've been...
So this is going to be like a decision-making quarter,
yes,
right? If you're an investor, it's a decision-making quarter.
Absolutely, for the whole host, but CIBC and Scotia in particular, because those have been the two that have been beaten up, that don't have a good story or good thesis out there. Now, CIBC has actually been doing some very good things in terms of what they stated they were going to do in terms of a little bit of growth, controlling expenses, but it just hasn't been enough. And with the outlook that the Canadian consumer could be hurt with their exposure primarily domestically, they get thrown in the junk bin.
TD has also been thrown in the junk bin. It has not recovered since the Silicon Valley Bank issues. It's got champagne problems, though, doesn't it? It is just sitting on all this capital at a time where other banks might be capital constrained with what's going on the regulatory front. Why not stick your neck out for this one?
Well, we actually do like TD and where it's situated, but again, in the near term, we think there's some issues that will resolve themselves when the economy sorts itself out. But in the near term, we do have some underperformance coming out of their ownership in Schwab, which will be a negative this quarter.
And that's back in the forefront of minds with all of these debt downgrades.
Absolutely. As well, they're overexposed to the consumer, which is expected to be hit worse than businesses through the economic slowdown. And even though they've got a whack of capital which supports them in an economic downturn, all that capital is dampening their return on equity. And so on a relative performance basis, that gives them a bit of a headwind. Now, if they came out and said, we're going to buy back a lot more shares than they did on the initial announcement, we'd be much more positive on the name. But we don't think they're likely to do that, one, because of the uncertainty of what the economic outlook is, but two, the regulatory environment has kept on increasing capital, and so aggressively dropping it down is not a good play right now.
Big picture question, why isn't the resiliency in the housing market being a bigger tailwind for the Canadian banks, the big ones?
Because nobody believes it. Expectations are that with economic weakness, you'll see some pressure on housing prices and then potentially pressure on the residential mortgage market. We're actually reasonably bullish on the outlook for housing just because of the supply-demand issues are propping up pricing. We may see some weakness, but a 10% drop in housing prices would require a severe recession, which is pretty much off the table right now.
But Home Capital, Equitable, I mean, they're doing, Home Capital is kind of out of the public market, so we use Equitable as an example. They're, it's going gangbusters for them. Are the big banks losing market share because they are being more prudent?
Yes, and they're very reticent to pile on residential mortgages at this stage in the game, given the stretched outlook for not only pricing, but also the debt-to-income levels of Canadian households. Now, when you look at some of the other players in the market, they do a different lending where they're lending against the value of the home, not necessarily against the income, which is a very different dynamic than the Canadian banks have, and so the business model is a bit different.
Insurance stocks have outperformed the banks, but recently the Manulifes, the Sun Lifes of the world, they have also rolled over. You prefer the insurers over the banks. Why is that, and when does that change?
Structurally, a higher interest rate environment benefits the life cos more than it does the banks. And we actually saw that last quarter where the banks' net interest margins, after getting a lift for several quarters, felt the pressure. The issue that with the insurers, though, is they have big investment portfolios underpinning their actuarial liabilities, and some of that actually is in commercial real estate, which is a bad word these days. Now, that being said, we don't think there's any real weakness in the commercial real estate holdings of the life insurance companies, but which makes it a bit of a buying opportunity in this dip. But longer term, the market is just going to have to get comfortable with that, and that may take several quarters, even years of performance to basically alleviate those concerns.
All right. So it sounds like you're getting cautious.
Yes.
All right.